Welcome to the Deep Dive. Today we're dissecting the Q2 2025 earnings call for Nuwellis, ticker NUWE.
That's NUWE.
Right. And this past quarter wasn't just, another period for them. It was marked by some really significant strategic shifts.
Big changes.
Yeah, all aimed at refocusing their business. We're here to unpack the numbers, delve into what management actually said, and really try to figure out where this company is heading.
Exactly. We'll walk you through the critical details from the call. We'll identify the key drivers, both the good and the bad, behind their performance. And maybe most importantly, look at those strategic decisions that are going to shape their future.
Mm-hmm.
Our mission, like always, is just to distill the essential info you need to understand Nuwellis' trajectory, without you having to read pages of transcripts.
Let's get straight to it then. The headline numbers for Q2 2025, Nuwellis reported revenue of $1.73 million.
Which was down?
Yeah, which unfortunately represented a 21% year-over-year decline.
Yeah.
And their GAAP EPS, wow. It came in at a significant loss, negative $60.99.
Oof. Yeah, those are stark figures. They definitely grab your attention.
They really do.
But, management was quick to point fingers, attributing a direct $0.4 million revenue hit to a temporary. And they stressed temporary industry-wide sterilization vendor backorder.
Ah, okay. So an external factor.
Apparently. And the good news here, according to them, is that this issue has been fully resolved, fixed in the first week of July.
Okay, that's crucial then. Suggests maybe a one-time hit, not an ongoing problem.
That's the narrative, yeah. We'll see if it holds.
Right. Okay, shifting to the balance sheet. They ended the quarter with $4.5 million in cash, and importantly, no debt.
Zero debt. That's always nice to see.
Definitely. And this position was helped by a $5.0 million gross capital raise they completed during the quarter.
Right, they brought in some cash.
So how did the market react to all this? The numbers look rough, but there's this backorder explanation.
Well, the immediate reaction was pretty muted, actually. The stock opened flat.
Flat. Interesting.
Yeah, but then it actually saw a modest gain by the end of the day and on significantly higher trading volume, too.
So what does that tell you? Maybe investors were looking past the headlines. Or just confused?
Maybe a bit of both. I think that muted start, then the small gain on high volume, it suggests investors were discerning, not punitive.
Okay.
It kind of hints that maybe the market's giving management the benefit of the doubt on the one-time sterilization thing, and maybe, just maybe, acknowledging those strategic shifts they also talked about.
Right, the bigger picture stuff.
Exactly. They're not celebrating, but they're not panicking either. It feels like a show-me period now.
Okay, let's unpack this more, dig deeper. Starting with that sterilization vendor issue. Beyond the raw numbers, what were the specific impacts? And what does resolved really mean for Q3 and beyond?
Okay, so that issue mainly hit revenue in their heart failure and cardiac surgery segments. Those were the areas affected most. But what's kind of interesting here is that the company said they prioritized allocating the inventory they did have to pediatric patients during that time.
Oh. Okay, so they made a choice there.
Yeah, which shows, a focus on that particular group. Now, the full resolution in early July, it means they're officially not in backorder anymore, right. And they're actively building up finished goods inventory again. So that should set a stronger footing for this current quarter, Q3.
Theoretically.
Theoretically. The real test is how fast they can fully restock and, if this industry-wide issue truly doesn't pop up again.
Good point. Okay, so that inventory prioritization for pediatrics. That's an interesting detail, but let's talk about the bigger changes. Nuwellis is undergoing some fundamental strategic shifts. They're actively exiting international operations, pulling back completely to focus resources just on the U.S. market. That feels like a pretty bold pivot.
It is bold, putting all their eggs in the U.S. basket, basically.
Exactly. What's the thinking there? And what are the risks? What if the U.S. market doesn't perform like they hope?
Well, the rationale seems clear. Focus the money in the sales effort, where they see the strongest demand signals and, maybe more importantly, the best reimbursement economics.
Right.
And for them, that means pediatrics, cardiac surgery, and this emerging hospital-based outpatient channel.
We'll get to that.
Yeah. The risk, obviously, is concentration. Like you said, if one of those U.S. segments stumbles, there's no international buffer.
There's a safety net.
None. But the potential upside is becoming much leaner, cutting low-margin international stuff, and hopefully becoming more profitable here if the U.S. strategy works. It's definitely a high-stakes bet.
Okay, and speaking of efficiency, there's this parallel shift happening in manufacturing too, right?
Yes, absolutely. They're transitioning manufacturing over to KDI Precision Manufacturing.
KDI Precision. And the go-live is planned for October.
That's the plan.
October.
Now, transitioning manufacturing. That can be really complex, really risky for medical device companies. What kind of challenges do you see them facing? And how confident can we be that October will be smooth, without more supply chain issues?
Yeah, that's a critical point. These transitions often hit bumps. The hope is that this move cuts their fixed costs, improves reliability, and, generates real savings over the next year or so.
The hope.
The challenge is transferring knowledge, validating all the new processes, making sure quality control stays absolutely perfect. That's huge in medical devices.
Of course.
So while go live is October, the real test is going to be consistency and scale in the months after that. Investors will be watching like hawks for any hint of delays or quality problems, especially since they just had that backorder issue.
Understandable. So it could boost margin significantly, or?
Or it could introduce whole new headaches. We'll see.
Another big decision they made was terminating the reverse HF clinical trial.
Right. Pull the plug on that one. And they're reallocating about $4 million that was budgeted for that trial towards what they're calling higher impact growth areas. Management was clear. They said this wasn't about device performance or safety, just a strategic reallocation of cash.
Yeah, they emphasized that point.
Does this signal maybe a more disciplined approach to R&D spending? Or could you see it as them kind of pausing their innovation pipeline?
That's a good way to put it. I think it absolutely signals more discipline with capital allocation, which, frankly, for a company with that kind of EPS loss and burning cash is probably necessary.
Makes sense.
It's about prioritizing the growth opportunities they think are, higher probability right now over maybe longer term, more speculative R&D.
So less blue sky research.
Probably less blue sky, yeah. Some might see it as an innovation pause, but I tend to view it as focusing limited resources where they believe they can get the best bang for their buck in the near to medium term.
Okay.
The key, though, is whether these higher impact growth areas actually deliver like they expect. It's a clear trade-off they're making.
Right. So connecting the dots, their growth strategy now seems laser focused on 3 areas. Let's start with pediatrics. You mentioned they prioritized inventory there.
Yeah.
It remains a cornerstone, showed a healthy 23% year-over-year revenue jump in Q2, even with the supply issues. Their Aquadex device has that unique FDA clearance for kids down to 20 kilograms.
Tiny patients, yeah.
And they now have 47 pediatric centers using it. What makes pediatrics such a strong spot for them?
Well, pediatrics is interesting. It's often a high-need area, lower volume maybe than adult markets, but also less price-sensitive sometimes.
Oh.
That unique FDA clearance for very small patients gives them a real competitive edge. It's a niche where their device has a clear clinical advantage.
Fewer alternatives, maybe.
Exactly. And the fact they grew 23% in a tough quarter, even with prioritizing, suggests strong underlying demand. Getting into 47 centers shows they're building a real footprint in a market that values specialized, safe solutions.
Okay, that makes sense. Area number 2, critical care, especially cardiac surgery. They're seeing more adoption there too. The pitch is that Aquadex can manage post-op fluid overload, protect kidney function in these really sick patients. How big is this market? And what's the specific edge Aquadex offers here?
The cardiac surgery market is pretty substantial. Lots of procedures happen every year, and managing fluid after surgery is always a challenge.
Right.
Aquadex's advantage is its gentle, precise fluid removal ultrafiltration. Traditional diuretics can sometimes be, too blunt an instrument. They can cause electrolyte problems or stress the kidneys more.
Actually.
So for patients recovering from complex heart surgery, keeping fluid balance just right is crucial for recovery. Aquadex offers a controlled way to do that, potentially avoiding those side effects, maybe leading to better outcomes, shorter hospital stays. That's attractive to doctors.
Okay, controlled and gentle. Got it. And then area 3, the outpatient heart failure opportunity. This seems like the one they're really hyping up.
It really does. This could be the pivot point.
Why? What makes this such a potential game changer for Nuwellis?
Okay, the absolute game changer here is a new CMS code, a new reimbursement code. The money.
Exactly. It dramatically increased the payment rate for outpatient Aquadex treatments. It went from about $413 per day
to
$1,639 per day.
Wow. That's almost 4 times higher.
Nearly 4x, yeah. And that completely transforms the economics for hospitals thinking about doing this outpatiently.
Right. It makes it actually viable.
Totally viable. Before, it was probably a money loser for many hospitals. Now, with that kind of reimbursement, it opens up a much more scalable way to manage chronic fluid overload in heart failure patients.
Yep.
Before they get so sick, they need to be admitted.
So shifting it from an emergency inpatient thing to more proactive outpatient care.
Precisely. Think scheduled treatments to keep people out of the hospital. That's the potential.
That is a big deal. It fundamentally changes the market opportunity for Aquadex. But how quickly can hospitals actually set this up and adopt it? Are we talking months, years? What are the hurdles?
Yeah, great question. It's not just flipping a switch. Nuwellis said they've treated their first patient under this new payment system at Prisma Richland Hospital.
Okay, so one proof point. One proof point. And they report several other hospitals are in the process of setting up similar clinics. The adoption curve could vary a lot.
Right.
Big academic centers might move quicker. Smaller community hospitals might take longer resources, staff training, setting up new workflows. It takes time.
It's not just about the money, it's integrating it.
Exactly. It's integrating a whole new treatment approach. The first few wins are promising, but getting widespread use will need ongoing effort, education, and proving the value to administrators.
Okay. Lastly, on the innovation front, they got a new U.S. patent.
Yeah.
Fluid bag design. Helps with safety, workflow. That's good for long-term IP.
Yep. Always good to build the patent portfolio.
It's worth noting, management didn't give any quantitative guidance for the full year or even for Q3.
No numbers.
No numbers. Just emphasize this narrative of recovery, supply constraints resolved, focus on core markets. What does that lack of guidance tell you? Confidence. Uncertainty.
Yeah, the patent is nice, but the lack of guidance is telling. It suggests that while they say the backorder is fixed and they have clear plans, there's still too much variability or maybe just uncertainty in the immediate revenue picture to put hard numbers out there. It's kind of a classic case of asking investors to trust the story, trust the narrative of recovery and focus, rather than giving concrete financial targets to hit.
So more wait and see.
Definitely puts investors in wait-and-see mode. You can't really model the next quarter based on management's word alone. You need to see the actual results come through.
Which brings us back to the market reaction. Muted, wait and see. Despite the big EPS miss, risk feels elevated with the Q2 softness, the cash burn.
For sure.
And Nuwellis stock has lagged its med device peers significantly over the past year. That puts a really high bar on them now to improve operations, doesn't it?
Absolutely. A very high bar.
So what specifically does management need to show, like in the next quarter or two, to start regaining credibility and maybe closing that valuation gap?
Tangible proof points. That's what it comes down to. First, they absolutely have to show consistent supply now. No more backorder talk. The KDI manufacturing transition in October needs to go smoothly. That's table stakes.
Non-negotiable.
Non-negotiable. Second, and this is the big one, they must convert those outpatient pilots with the new CMS code into repeatable, scalable revenue.
Show us the money.
Show us the money. Announce new hospital wins for outpatient clinics. Show that patient throughput is actually increasing in places like pediatrics and cardiac surgery, too. Even small operational wins, like better order patterns, could really help reset expectations. They need to show the strategy is working in the real world.
So, bottom line, it really sounds like the company's future credibility just hinges completely on execution now.
That's exactly it.
Investors need more than just talk about strategic shifts. They need to see it translate into consistent financial performance and ultimately a clear path to being cash flow positive.
Precisely. The next few quarters are absolutely critical.
Yeah.
Can they execute on that outpatient opportunity? Can they nail the KDI transition? Those are the key things to watch.
So, okay. Now, for the segment where we speculate a little bit and reminding everyone listening, this is purely for educational purposes, definitely not investment advice.
Not financial advice.
It's time for This Is Not Financial Advice.
All right. So given everything we've discussed about Nuwellis' Q2, the huge EPS miss, the revenue drop, but also the resolved supply issue and that potentially massive CMS reimbursement increase, an outrageous, but maybe just plausible trade idea for a really speculative investor could be something like this. Consider a highly out-of-the-money, long-dated call option, like a LEPS.
A LEPS option, so long-term.
Yeah, long-term equity anticipation securities. Think maybe 18, 24 months out, and with the strike price significantly higher than where the stock is trading right now.
Yeah, that definitely sounds speculative. Out-of-the-money, long-dated calls on a stock that just missed big. You called it outrageous.
Right.
What's the biggest risk? What makes it potentially go to zero?
Well, the outrageous part is betting on huge returns from a company that just posted that kind of loss and has struggled, right? The biggest tripwire is simple: execution risk.
If they don't deliver.
If that outpatient model doesn't scale fast, if the KDI transition hits snags or causes new supply problems, if the cost savings don't show up, then the stock probably just keeps drifting, or worse.
And the option.
And call options, especially way out of the money ones, they have that ticking clock. Time decay eats away at their value. If the good news, those catalysts, don't hit relatively quickly and powerfully, that option could very easily expire completely worthless. It's absolutely a high-risk, potentially all-or-nothing kind of play.
Okay, so that's the scary part. What's the plausible part then? What has to go right, maybe even perfectly, for this kind of trade to actually pay off big time?
The plausible side hinges completely on hitting those key execution points we talked about, specifically successful and rapid scaling of that new outpatient heart failure model because of the 4x higher CMS payment.
Okay.
Combine that with the KDI manufacturing transition actually delivering significant margin improvement and supply stability. If both of those catalysts hit hard and fast,
Then what?
then the operational leverage could be huge. The cash flow generation could suddenly look way better. And that combination could fundamentally re-rate the stock. It could make today's price look incredibly cheap in hindsight.
So widespread hospital adoption of outpatient, much better margins from KDI.
Yeah, throw in consistent revenue growth on top of that.
Right.
That combination could send the stock flying. But again, it is a very big if. Everything needs to fall into place.
All right, well, that definitely wraps up our deep dive into Nuwellis's Q2 2025 earnings. It's certainly a company in the middle of a major strategic pivot.
Big pivot. Betting bid on that refocused U.S. strategy and hoping operational efficiencies drive the growth?
Yeah, the next few quarters are going to be absolutely critical for them to show these shifts can actually turn into better financial results.
Absolutely. Executing on that outpatient opportunity, nailing the KDI manufacturing integration, those are the key things we'll all be watching.
And remember, everyone, this deep dive is for informational purposes only. It is not financial advice. We're just here to help you get informed quickly.
That's right. Thanks for joining us on Talk Tickers. As always, we encourage you to do your own research and analysis.
And if you found this deep dive valuable, maybe share it with a friend. And hey, send us your sources for future deep dives too. Until next time, stay informed.